Chapter 8. The Decade Nobody Plans. The presenter asked the room a simple question. He was a retirement specialist, brought in by James's company for the annual benefits information session. The room held about 40 people, engineers, project managers, a few senior directors. Most of them were in their mid to late 50s. All of them had been saving for retirement in one form or another for 20 or 30 years. The question was, how many of you know what tax bracket you'll be in during your first year of retirement? Nobody raised a hand. The presenter nodded as if this confirmed something he already knew. He moved on to the next slide. The session continued for another 40 minutes, covering contribution limits and fund options and the company match schedule. James drove home afterward thinking about the question that had gone unanswered, not because it was unanswerable, but because no one in a room of careful, accomplished people had ever thought to answer it. He mentioned it to his wife Patricia that evening. She said, "I assumed it would be lower than now." He said, "I assumed that too." Neither of them had checked. James is 55. He and Patricia have $980,000 in their 401k, $140,000 in a brokerage account, and 12 years left on their mortgage. By the standards of their generation and their income, they are doing well. By the standards of what the next decade will actually require of them, they are at the beginning of something they haven't fully recognized yet. The last 10 years before retirement are not simply more accumulation years. They look like accumulation years. The balance is still growing, the contributions are still going in, the horizon still feels distant enough to absorb mistakes. But something fundamental has changed in the underlying math, and the change is invisible until you know to look for it. During these years, the decisions that determine retirement's actual structure are being made or not made. Tax positioning, account composition, Social Security coordination, healthcare bridge planning. The questions that feel like future problems are, in fact, present problems, because the window to address them is open now and will begin closing on a schedule that doesn't announce itself. James does not know this yet. He is doing what successful people in their mid-50s typically do, managing his 401k, reviewing his allocation annually, assuming that the harder retirement questions are questions for later. Later is closer than he thinks. Here is what is true about the decade between 55 and 65, for someone with James's financial profile. The tax bracket he occupies during these high-earning years is the highest it will ever be. Every dollar that goes into his traditional 401k is deferred at that rate, but the deferral creates a liability. The $980,000 he's accumulated will eventually come out, taxed as ordinary income, in a tax environment he cannot predict but can partially shape right now. The window to move money from tax-deferred accounts to tax-free ones, paying taxes now at a known rate rather than later at an unknown one, is widest in these years, before the conversion interacts with Social Security income and mandatory distributions and whatever tax legislation the following decade produces. The window does not close on any specific date. It narrows gradually as other income sources arrive and reduce the flexibility to act without jumping brackets. The Social Security decision he will eventually face, not for many years he assumes, is actually shaped by choices made now. How long he works, at what income, whether he coordinates with Patricia's benefit, whether either of them has thought about what the surviving partner's income looks like after one of them dies. These are not separate questions from retirement planning. They are the same question asked earlier. The healthcare problem, the cost of maintaining coverage between retirement and Medicare eligibility at 65, is a real constraint that will affect when he can actually afford to stop working, and it is cheaper to plan for now than to discover at 62. None of these things require James to act today. They require him to understand today that they exist, and that the understanding is time-sensitive in a way that portfolio management is not. There is a concept in engineering, James would understand it immediately, called path dependency. The idea is that certain outcomes are determined not just by the final state of a system, but by the sequence of states that preceded it. Two systems can reach the same configuration through different paths and have fundamentally different properties as a result of how they got there. Retirement finances are path-dependent in exactly this way. A person who moves money from a traditional IRA to a Roth at age 58, in a year when their income is high but manageable, pays a specific tax at a specific rate, and creates a specific asset that will grow tax-free for potentially 30 years. A person who takes the same amount as a mandatory distribution at age 72 does so in an entirely different tax context, with entirely different consequences. Same action, different path, different outcome. The decade before retirement is when path selection happens. Most people are not aware they are selecting a path. They are simply continuing the behaviors that worked during accumulation, contributing, investing, staying the course, without recognizing that the game has changed around them. Accumulation rewards patience. It rewards consistency. It is largely forgiving of timing because time is the primary resource and time is abundant. Distribution requires something different. It requires decisions made in a specific sequence within windows that have actual edges. The patience that served James well for 30 years will not on its own serve him well for the next 10. The people who arrive at retirement with the most flexibility, the ones who, unlike Margaret, still have choices, unlike Linda, have not yet encountered the thing the plan didn't account for, are not necessarily the ones who saved the most. They are often the ones who used the decade before retirement differently. They structured their assets so that retirement income could be drawn from multiple sources in sequences that minimize lifetime tax exposure. They thought about Social Security not as a form to file, but as a decision with decades of consequences. They built the bridge to Medicare into their planning rather than encountering it as a surprise at 62. They did not do these things because they were more disciplined savers. They did them because someone asked them the right questions at the right time. The pre-retirement decade does not feel urgent. That is precisely the problem. James is still earning. The account is still growing. The horizon still feels forgiving. Nothing in the structure of his daily life signals that a set of irreversible choices is being made, or not made, right now, in this particular window, while the window is still open. This is what makes the decade different from all the others. During accumulation, delay is recoverable. One more year of contributions, one more year of compounding, time is on your side. But during the pre-retirement decade, delay has a different character. The windows do not wait. They close quietly, on schedules that do not announce themselves, and they close whether or not anyone was paying attention. James drove home from the retirement seminar, mentioned the unanswered question to his wife, and went to bed. Nothing dramatic. Nothing irreversible, yet. But the decade is moving whether he is or not. What is exceptional is the moment, the drive home, the conversation with Patricia, the realization that an assumption both of them had been carrying for years had never actually been examined. I assumed it would be lower. I assumed that too. Neither of them had checked.